So we're going to enlighten you today as to why the rich get richer, simply because they don't have to pay as much tax, as at least a percentage of tax, as you do. So it's a very important show because it's tax time coming up around the corner. And if you're saying, well, I should have done tax planning, I hate to say this, might be too late. But there's still next year. There's still hope for next year. So, Kim, what do you want to say about taxes? Because that's one of our favorite subjects, because taxes make the rich richer.
Yes, and most people don't understand that. So most people are thinking, oh, my God, tax day is coming up, and they cringe, and all they can think about is how much tax they're going to pay. So, yeah, as you said, if they're starting to plan today, it's a little too late. However, we're going to have some experts on our show that are going to show us how the tax system can work to your advantage and to benefit from the tax system instead of being at the effect of it.
So our guests today are Rich Dad advisor Tom Wheelwirght. He is my expert on taxes. He's the founder and CEO of Provision, the premier strategic CPA firm, and he's the author of Tax-Free Wealth. His website is provisionwealth.com. And I've never met this gentleman before, but as Kim says, he blew my head up into a balloon.
Talk about being validated.
I'm doing my best to be humble and, all that other stuff, but it's tough. It's Ed McCaffery. He's an internationally recognized expert in tax law, teaching at USC. He's also a contributor to CNN.com, and he's author of Tax Planning 101, Buy, Borrow, Die, Fair Not Flat, but how to make the tax system better and simpler.
And the reason your head gets bigger is because Ed is actually using the your Rich Dad, Poor Dad principles at the USC Law School, and it doesn't get a lot better than that.
Yeah, that'd be like the Pope endorsing me or something like this. It really doesn't get much.
Right on, everybody, but this is Ed, and I'm really happy to be on this show. Listeners, Robert is not puffing his own head. We talked before, and I just told him how honored I was, and Kim, and to have Tom also on the phone, because I think the tax planning advice that comes out of Rich Dad, Poor Dad, I think we should be learning that in kindergarten. I think that's very important, essential advice. And what Robert and his various colleagues and co-authors have done has been to make that clear and understandable.
So, Ed,
I hope all listeners, continue to listen. So I'm happy to be here talking about that.
Thank you, Ed.
So let's. So Tom, like you've been on the program many times, but for those who haven't had you on the haven't heard you before, please give your background on what qualifies you to talk about taxes, because I don't have those qualifications. But Tom guides me in my writing and making it simple for people like Kim and I to understand. So, Tom, what is your background when it comes to tax?
Well, so I have a master's of tax from University of Texas, little school down in Austin, and spent many years with one of the big four accounting firms, Ernst & Young, including 3 years in their national tax office when the last major tax act was passed, 1986. And then the last 20 some odd years have been really working directly with entrepreneurs and investors and really teaching them that taxes can work in their favor if they understand, the basics of taxes.
And Tom, you say you work primarily with entrepreneurs and investors because those are the people that can take advantage of the tax laws, correct?
Right. If you're a high wage earner, quite frankly, and that's all, and you're saving your money, there's not a lot we can do for you. So the people that we can really help are the people that are, as Ed says, they're the ones who are buying, and then we borrow it, and then hopefully we push the debt out a little ways. But that's actually something. By the way, Ed, that is an example I use. So buy, borrow, and die is an example I use in my book, Tax-Free Wealth.
Great. Well, we're all on the same page, and I think that's a page that Robert really helped us to start. And everything Tom said, I would agree with. It's a kind of clever of the Kiyosakis to have someone from Texas and someone from USC on the same phone call. Not in what happened a few years ago in that department. Right. When you take buy, borrow, die, and the buy part, it comes from Robert and Rich Dad, Poor Dad. Rule number one, buy assets. When you have an asset and that asset goes up in value, you don't pay tax on that. You don't have to report that income until and unless you sell it. And, of course, the plan here is not to sell it. So you buy and hold. You buy assets. And then if you need wealth to live on because it's hard to eat unrealized appreciation, you're going to borrow. That is a strategy that allows Warren Buffett and people like Warren Buffett and the entrepreneurs that Tom advises to pay almost nothing. But it is also a strategy that is available to a more middle class or upper middle class audience. For example, you buy a house. Hopefully many of our listeners have done that. It's a lovely thing to do. And not just because of the mortgage interest deduction. The house goes up in value. If it's a house in Hawaii or California or Texas, eventually you hold it long enough, it will go up in value. When you want to pay for your kids' education, when you want to go on a trip, what do? You borrow against your house. And that's a way, and if you keep doing that, actually, if you sell your house, you get some of that gain back tax-free, and you can pay off your debt.
Ed, thank you for all that, but I want you to introduce yourself first. So, I mean, we know who you are. But I am.
I understand. Ed gets as excited about taxes as I do.
I know. You're the only two people I know that get so excited about taxes.
Ed, the point here is this: if I said such things, nobody would listen to me because I have no credibility. But your CV, your credibility is incredible. So before we go any further,
I'm not. That's kind of you. I'm not sure all the readers will agree. I did go to Yale College and then Harvard Law School. I've been teaching, and then I got a degree in economics from USC when I was teaching here. I've basically been teaching tax at USC since 1989. I also teach law and economics at the California Institute of Technology, and I've taught tax at Yale Law School, UCLA Law School, and Harvard Law School. I've written several books. Robert was kind to mention them. Just so people, don't think I'm some kind of, brilliant genius. I'm enough of an idiot that I'm trying to take these basic principles of tax that Robert and Tom and Kim and other people are explaining to people like the listeners and the readers as a way to help them live their lives in a tax-free or tax-reduced manner so they can have more wealth for themselves. What I'm trying to do is take those principles and explain them to politicians to help fix the tax system. And that is a hopeless quest. So I am not as well-dressed or as well-paid as anybody else on this phone.
So, Ed, we love your message. I just thank you for the years and years and years of saying what I was saying. And most people thought I was talking about tax evasion, And that's not what we're talking about here. So in a simple question, I'm going to ask Tom this question. Is it legal for the rich to pay no tax?
Certainly. Oh, yeah.
That's all I'm saying. Because every time for all the years I was, talking about tax, which I have no credibility in, people would say, you're talking about evasion, aren't you? And the thing that Tom and I always talk about, there's a lot of people who do talk about tax evasion, but the average person doesn't know about it. Isn't that correct, Tom?
Well, and that's a good vocabulary there, Robert. Tax evasion is criminal. Wesley Snipes most recently did that. That's when you get a bunch of money and you just stick it under your mattress or put it in another country and don't tell the government you got that money. The key to tax-free investing, the key to Rich Dad's advice, is that you don't show that income in the first place. Again, the lovely quote from Rich Dad, Poor Dad, rule number one is to buy assets.
Any comments, Kim?
Yes, so this is a very, very timely show because actually there are things that you can do regarding your taxes, and we have two experts with us today. Tom Wheelwirght, who's our Rich Dad advisor on taxes. He advises Robert and myself, and he keeps it very simple so that we understand what's going on out there. His book is Tax-Free Wealth. And also Ed McCaffery. He's an internationally recognized expert in tax law. He teaches at USC Law School, and he is the author of Tax Planning 101, Buy, Borrow, Die, and he actually uses Rich Dad, Poor Dad in his teaching at USC.
And that is, my head. I'm going to float out of this room right now, Ed. So anyway, just for those who may not understand the Rich Dad philosophy, is that when you say to your child, go to school, which is my poor dad, I always say go to school and get a job. The moment you are working for money, you become a tax and wage slave. So what Tom has been teaching Kim and I and guiding us all these years, but also teaches Rich Dad listeners, which is Ed does, there's also ways you can legally minimize tax. And one of the things Tom always talks about is not that taxes are punishment. Taxes punish people who work for money. But it also is an incentive for those who do what the government wants done. Any comments on that, Tom, that distinction between tax law or incentives to do what I do? I invest in houses, in apartment houses, oil wells, and things like that. I have a company because we have employees. I'm doing what the government wants done. On the other side of it, the socialists like Hillary and Bernie Sanders are saying we're cheating the system.
They call it loopholes.
Well, no question. And what happened was, and Ed can back me up on this, I'm sure, is that the government learned years and years and years ago that, first of all, people hate paying taxes. So if you give somebody a relatively small tax incentive, they will do big things with it. They will go after it. They will build low-income housing. I mean, can you imagine what little amount of low-income housing we would have without that tax incentive? That's the incentive. Depreciation in real estate, depletion and intangible drilling costs on oil and gas, business deductions. I mean, everybody knows that, boy, everybody's got a friend, even if they're a wage earner. They've got a friend that has a small business, and they say, I get to write off part of my house. I get to write off part of my car. I get to do all these write-offs. These are intentional because the government wants people to build business, because if people build business, they grow the economy, and they actually create additional jobs.
And so Tom, even if they have a part-time, they have a full-time job, and they have a part-time business, they still get these tax incentives, correct?
Absolutely. I mean, that's the thing, is that the tax law, as Ed was talking about earlier, is that, the tax law is not just for the rich. The tax law is actually for the entrepreneur. So it doesn't have to be the entrepreneur that is out there making millions and millions of dollars. It can be the entrepreneur out there making, $50,000, $100,000 a year. They still get the same tax benefits.
The other thing that you talk about that gets people's the hair on the back raises up, they also give you tax incentives for charitable donation, right?
Yes, and in fact, they just actually in the last tax law that was passed in December, they gave some additional incentives for charitable donations. But this is a good example. Ed's talking about buy, build, and die. Is that when if you buy appreciated stock and you give it away, you don't pay tax on the gain, and you get a deduction for the full value of the stock. So that's like a twofer. I mean, you get both. You don't pay tax, and you get the deduction. So
once again, it's Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And today we're talking about taxes because it's the election year, and Hillary's talking about taxing the rich. But I want Ed to go in on this because what Tom, Kim, and I understand, they don't really tax the rich. They tax the rich who work for money, the wage guys.
The high wage earner.
Yeah, and just for your edification, this is what Tom taught us, is there's three basic types of income. One is ordinary, which is when you work for a company, it's ordinary income. Your savings are taxed at ordinary income rates, and your 401k is ordinary income. So they punish the poor and middle class. There's capital gains, which Wall Street runs heavily on capital gains. It's a thing called CEW, corporate equity withdrawal. It's like you borrowing out money from your house. So the rich get really rich by jacking up the stock market, borrowing this all out. They don't pay tax on it. And then there's cash flow, or also called passive income. So Kim and I are very, very heavily involved in passive income or cash flow, which is why we never need a job, because our income comes basically coming in at us tax-free. The more we buy more real estate, the less tax we pay because we're using debt, which the government wants us to use. So those things are like taboo subjects to the poor and middle class, so it's a little hard to understand. So we're very grateful to have Ed McCaffery again, went to those little schools called Harvard, Yale Prep School, and he is an attorney. So I want to make sure that I'm glad he's on. I thank him for supporting our work. But what do you have to say about that? I mean, it's a shift in mindset primarily for many people, right, Ed, on taxes?
Well, that's absolutely right, Robert. And all three of you have really hit on the main theme, which is that wage earners, people who go and work traditional jobs, they're the ones who are financing the government. And people who can live off a more entrepreneurial lifestyle or who can live off their savings can avoid and really eliminate taxes. And let's put another piece into the explanation for that, which is the government's competence. The government, the IRS, isn't all that competent. They're not that well-funded. They're not that competent. If you're working in a traditional way, your employer is rat-thinking on you. The employer is sending in a W-2 form because the employer wants to take a tax deduction for the salary that he pays you. And that W-2 form goes through a computer, and the computer tells you how much you're going to pay. That's why the good news for the poor and the middle class, they don't have to pay very much to prepare their taxes. H&R Block will do it for practically free because it's simple. The bad news is they're going to be taxed in a very difficult-to-avoid way. So everybody on this phone call is exactly right. The key to keeping more of your money is to get off the treadmill of a traditional salary job where your taxes are very difficult to avoid and get on to a more independent path where you're investing, you're owning assets, you're doing real estate as the Kiyosakis do. That's the key to the whole thing. Wages, working, salary, highly taxed, ordinary rates, as Robert said, the highest rates. And then to Kim's point about what's coming down the pike and the politics, Hillary Clinton is proposing increasing taxes on wage earners.
When she says taxing the rich, she says she's going to tax the rich. She's not really taxing the truly rich, is she?
Yeah, if you have a W-2 that shows more than $5 million a year, a W-2, you're taking a salary of more than $5 million a year, Hillary's raising your taxes. Not many people in that category.
So here's a great quote on this one. Robertson Williams, who's at the Tax Foundation, he says, the Clinton proposal would surely push some high-income taxpayers into paying taxes higher than middle-class households. But because of the nature of their income, some higher-income people could still be paying relatively low taxes. That's what we're talking about.
Right.
Absolutely. Absolutely right. And also, if, by the way, you're earning $5 million a year, you don't have to show all of that in salary. You have plenty of wealth. Convert it to stock options, put it offshore. Lots of things you can do
legally.
If you make more than $5 million a year. If you're making $40,000 a year, read Rich Dad, Poor Dad and start trying to think of redirecting your life, because the government is not going to help you if you're making $40,000 a year.
Thank you. Once again, it's Robert Kiyosaki, the Rich Dad Radio Show. The subject today is tax time. The tax man is coming after you. If you're thinking about tax planning, and what we're saying here is if you drank the Kool-Aid of going to school and getting a job and working hard and saving money, you're paying the highest taxes possible. And until you change your thinking via financial education or whatever, your taxes will just keep going up the more money you make. Our guests today are Tom Wheelwright, Rich Dad Advisor on Taxes, founder and CEO of ProVision, the premier strategic CPA firm specializing in dealing with professional entrepreneurs and investors. He's the author of Tax-Free Wealth, very simple book written for the layperson like us. His website is provisionwealth.com. And very honored guest today is Ed McCaffery, internationally recognized expert in tax law, teaching at USC. He's the author of Tax Planning 101, Buy, Borrow, and Die. It's really how the rich use tax strategies and planning to make more money and pay less in taxes, I think, which most of us would like to do. Comments, Kim?
Yeah, well, now we're in 2016. It's an election year, and I'd like to ask, start with Tom and ask, the whole election season, they're all talking about changing, reforming the tax system, all of this. What's your opinion on whoever gets elected? Is this going to affect me as a taxpayer?
I think it only affects you positively, Kim.
How so?
Realistically. Because what the Republicans want to do, they want to actually reduce the rates. So if they reduce reduce the rates isn't bad. But the key is it's what this Williams said in this quote about the Hillary Clinton is that because of the nature of your income, that's not going to change. Because the nature of the government is such that they want to promote certain activities, that as long as you're following those activities, it can't hurt you. And frankly, I think it could only help you.
Any comments on that, Ed? Election
Yeah,
time?
really just take the other side of the coin, not to disagree with Tom, but to put that same point in different ways. The government, any politician is going to do what's easy. Republicans, if they want to appeal to, an anti-tax electorate, are going to lower tax rates, as Tom said, and Democrats like Hillary are going to continue to tax wage earners. They're not going to do the complicated work to figure out how to reverse course. So let me give you an example. Obama didn't really raise income taxes until 2012. He wanted to, he didn't. But he quintupled federal cigarette taxes, taxes on cell phones, cigarettes, sales taxes, wage taxes of all forms. They're going up. And there's a saying that in the land of the blind, the one-eyed is king. People who even have a one-eye perspective on Rich Dad, Poor Dad, the entrepreneurs, the investors, the savers, they're not really going to be touched exactly as Tom said. So I think the message of Rich Dad, Poor Dad, the tax message of Rich Dad, Poor Dad, which is that it's foolish from a tax perspective to go to work and draw a salary, that is going to continue to become more and more true as governments that need money go to the easiest thing to do, increase wage taxes.
Ed, you just scared me.
Yeah, knock down that ordinary income, Robert. Let's get Tom working harder, because any ordinary income has a big target on its back, and those are very easy changes to make. Just say instead of 39.6, we'll have a 45% rate. Very easy to just increase the squeeze on the working classes, and that's what we're seeing.
Wow. Ed, I tell you what, I thank you very much for your integrity, your comments, and your generosity and humility. Like I said, it does back up my Rich Dad, and as Tom knows for years, every time I talked about not paying taxes or reducing taxes legally, most people are so afraid of the IRS or changing audits and all this stuff, they just freeze up and do nothing. So, they're so afraid of the IRS, they don't, keep their job, and they don't do anything, and they just work harder and pay more tax. And final words, Ed, because we're going to go to break.
Well, certainly aloha. And I think a final word is everything that you're doing and saying, Robert and Kim, and Tom is giving that advice, everything you're saying is perfectly true. I think whether that makes for a more sensible world is a big question, and it would be nice if politicians would actually care for the working people instead of taking advantage of the working people.
Amen.
And taking advantage of the fact that people don't understand taxes to do this headline-grabbing stuff that makes for bad policy. So amen to everybody on this call.
Exactly as Ed McCaffery says, you're a wage earner. If you went to school and you got a job, you're paying way too much taxes, and you cannot get out of that because the more money you make, you just move into another tax bracket. So that's why this program is a very, very important program. You can listen to this program. Everything's archived at richdadradio.com, and if you have a friend or a family member who really needs to understand taxes, because when Kim and I and Tom talk to people about taxes, their eyes glaze over. They're so afraid of a thing called an IRS audit, and they're so afraid of doing something illegal, they'd rather do nothing, work harder, and pay higher taxes. And our special guest, as always, is Tom Wheelwirght, Rich Dad Advisor in Taxes, and he guides Kim and I on our tax, how we work, how we invest, and what we do to legally minimize taxes. Tom is the founder of Provision, premier strategic firm. He's author of Tax-Free Wealth. You can go to his website called provisionwealth.com and find out, especially if you're an entrepreneur and a professional investor, Tom is the premier guy, right, Kim?
Yeah, and his book, Tax-Free Wealth, if you have a CPA, a tax strategist on your team, I would get this book and ask a lot of the questions that Tom raises, because a lot of tax preparers do not know this information, and they're not giving people the best advice, and they're costing people a lot of money. So I would recommend getting Tax-Free Wealth and bring it to your advisor.
Well, unfortunately, many CPAs pay the highest taxes, too.
True.
Because they're afraid of the thing called the audit, and they're so afraid of the IRS that they don't even think about doing something differently. So going into Tom, could you explain the difference between ordinary income, capital gains, and cash flow? Or they're also called ordinary, portfolio, passive. So my rich dad always told me to work for passive income or cash flow. That's what Rich Dad, Poor Dad's about. Whereas my poor dad always said, go to school, work hard, get a job, save money, and have a 401k, and that's ordinary income. So there's three types of income. And we give the distinction on that. Okay, would you mind take a moment on that?
No, absolutely. So think of ordinary income as income you work for. Okay, so when you say the rich don't work for money, the rich don't work for ordinary income because ordinary income is money that you work for. So that's why a 401k is ordinary income because you worked for that money. Okay, so anything you work for is going to be ordinary income. If you flip houses, you're working for that money. That's ordinary income. Capital gain.
Wait. And savings and interest on savings, right, is also ordinary?
That's ordinary income, too. And that's kind of an odd one because that's like, well, you didn't, I think it's because you worked for the money and then you put it aside, and now that money's paying interest, and so therefore, you're paying ordinary income. That's the best way I can think of that, but not that I think that's particularly good policy, but that's the way it is. Okay, so that's ordinary income. Capital gains, think of it as this is something that is a function of time. So as something goes up in value, okay, that's taxed to capital gains. So whether it's stocks or business or real estate, a house, whatever it is, as it goes up in value over time, okay, then it's capital gains. And capital gains historically have been taxed at about half the tax rate of ordinary income. So it's about half the rate.
So my father bought his house for $50,000. It went up to $1 million. So he had a capital gains there of about $950,000. That's what you're saying.
And the opposite of that is if you buy it and the price goes down over time and you sell it, there's a capital loss. That happens too. A lot of people experience that. Yeah,
capital losses are horrible.
Yeah.
So also what Ed was talking about, he says save, and he's talking about if you save stocks and it goes up in capital gains, exactly as we do in real estate, you can borrow out the gain. Is that true, using debt?
Yeah, true. Yeah, anytime you borrow because you owe the money back, I mean, it's not really income. Anytime you borrow, it's going to be tax-free, and so Ed's absolutely right. And so you can do it that way. If you're living on capital gains, and we don't typically talk a lot about capital gains because that's a buy, hold, and pray strategy. But if you do that, then yeah, you can absolutely borrow it out tax free, and even if you sold it, you'd only pay 15 to 20%.
So the point here is this: when guys say live debt free, they don't know what they're talking about from the rich dad side, right?
If you live debt free, you're paying really high taxes.
Right. So there's a way, and this is what financial education is about. Which was an honor to have Ed McCaffery acknowledging Rich Dad because we've been kind of the outlier for a while here. And what's the difference in cash flow or passive income?
Well, so passive income is actually income that somebody else works for. Okay, so think of it as ordinary income is income that you work for. Passive income is income that somebody else works for. So it could be employees who work for it. It could be Ken McCaffery who works for it, and you get the passive. It's passive to you. Anything
or your
that
tenants.
Your tenants pay your rent.
Your tenants pay, right? Your tenants are paying you, so they're working, right? You're not working; they're working to pay you. So it's passive income is somebody else is working for it, and they're paying you for owning that asset. Okay, they're paying for the use of the asset, or for for the use of your money. If you, in the case of a business, if you were to invest in a business, you could get passive income from a business too, and because the business owner is using your money, and so it's kind of rent on the money. So passive income in many ways is like rent, no matter what it is that you're investing in. It's actually a form of rent.
Right, and that's when I write a book, that income comes in, and what kind of income is that? Royalties.
Well, that's ordinary income.
Right.
That's ordinary income, and that's why it's important for you to have the passive. You actually have passive. You actually have the losses. You have ordinary losses that offset the ordinary income, and that's very important to have both of those.
And the losses come from investing in oil and gas and real estate.
That's right, because Kim's a professional investor, and this is what makes those. So Kim's not technically passive. I mean, the income may come in, and somebody else is working for it, but because Kim works with it, now it becomes active, and those losses you get to take against your business income and your royalty income.
So the last thing is this: when some people are listening right now, and number one, they're terrified of the IRS. They've never, they think what we're talking about is evasion, not avoidance. And so haven't you seen that more people would just rather pay it than go through the fear?
I do. I had this amazing conversation with another CPA the other day, and she was arguing with me over borrowing out money, debt. She kept saying, well, I said, look, our clients tend to be in a 25% or lower tax bracket. She says, well, how can they live on that? You just have no idea. I mean, talk about this tax education, and I think in her case, she's an agent of the U.S. government, because she's telling people, well, you've got to pay tax, because if you're going to have a nice lifestyle, you have to, that's what you have to do, and you have to pay tax to have that nice lifestyle. I'm going, why? Why would you ever do that?
Well, that goes to the point I hear from a lot of people. They say, "Oh, I plan to pay a lot in taxes because I'm going to keep making more and more money, so I don't have any problem paying more in taxes. That means I'm making more money." But they're all talking about the same thing. They're talking about wages.
They are. They're talking about earning their income. They're talking about that ordinary income. And I'm going, when you have a choice, and you have a clear choice of how you earn your income. I mean, it's like, I always use you as an example, Robert, is you're the best teacher I know, but you don't earn your money as a teacher in ordinary income. You earn it as business income.
Right.
So it's better income, so it's not taxed as high.
So once again, your book is Tax-Free Wealth, and that woman was a CPA who was saying that. Yeah. Jesus. Anyway, not all CPAs are equal. That's what I'm trying to say to you. Get Tom's book, Tax-Free Wealth, and give it to your CPA. Now, Tom, you're talking about the things that there's a new tax laws changed just recently. Yeah,
there's a lot of new changes coming down the pike for 2016, right?
Well, there are. In December, they passed what was, you'll love this, the name of this, Robert. It's called Protecting Americans from Tax Hikes, or PAT.
Well, it means they're all getting tax hikes.
You know that it's the opposite, right? But PATH actually, it did a lot of good things. For example, it made the research and development tax credit permanent. First time ever it's been permanent. It made the Section 179 deduction, which many people do know about this, which is a deduction for equipment that you buy in your business. It means that that's permanent now. It's up to $500,000. That's permanent. It's always been just, a temporary thing, and now it's permanent.
It was an incentive for a while to trying to manipulate the system.
And now it's permanent, which I think is really good policy. I actually think that the lobbyists had a heyday in December because they pretty much got everything they wanted.
Yeah, explain research and development, because that's what we do a lot of here, Richard.
You do, and research and development is actually a tax benefit that people don't take advantage of that I think more business owners could, and it's simply that when you're trying out new things and you're spending money on experimental type things, whether it be software or in your case it might be games or it might be learning methods or technology, all of that, there's a credit for that, and the federal credit is a good credit. It ends up being about 6%. So I mean there's huge tax benefits from basically investing in your business's future.
Discuss the difference between a tax credit and a tax deduction.
That's a big one, because a tax credit, that's dollar for dollar. So if you get $1 tax credit, you pay $1 less in tax. If you get $1 tax deduction, that's just off your income. So it's going to be at whatever your tax rate is. So if you're in a 30% tax bracket, $1 deduction is worth 30 cents. Okay, $1 deduction is worth 30 cents, but $1 credit is always worth $1.
Thank you.
So Tom, what other, as people are preparing now for send in their taxes and all of this coming up, what other changes are going to affect the individual taxpayer? Big ones.
There were a lot of them.
What are the main ones?
One big one is that they changed the education credit and they made it permanent, and so that's one that.
What does that mean?
Well, I mean, I think it's like a $2,500 credit now per year for all 4 years. Your kids go to college, and so that's something that you absolutely should be looking at. I mean, all of these. The important thing here is that to recognize that when you prepare a tax return, you know, there's not, I mean, like you say, not all tax preparers are created equal. And so make sure that your tax preparer understands the law and the changes in the law so well that when they're doing your tax return, they're taking advantage of all these and asking you all the questions to get that information so that they can reduce your taxes. Because when we prepare tax returns, we spend a lot of time reducing taxes when we prepare the tax return.
Final question
There's
is
a
this.
lot you can do.
Do you have to be rich to take advantage of the tax laws?
Oh my heavens, no! And you have to be an entrepreneur. I mean, the rich. You know, when Ed was talking about Hillary Clinton's proposed 4% tax on $5 million wage earners. Okay, well, there's a rich person who's going to pay more tax, but an entrepreneur could be making $100,000 and get benefits that $5 million wage earner doesn't get. So it's a matter of how you earn your money, not how much you earn.
Right. I have a doctor friend in California, and he's really happy he finally made $1 million, but he's going to pay 70% in taxes.
Oh, geez.
You know, that's not, I mean, why would you do that?
Yeah, I just don't understand. I mean, you know, it's not to say that you don't want to earn $1 million as a doctor. It's just that why isn't he, what's he going to do with $1 million, right?
Well,
because he should be investing in real estate, et cetera, so that he has offsets to that $1 million.
And the offsets could be real estate. The offsets could be a part-time business.
The point is, you don't have to be rich to pay less in taxes. Our guest today has been Tom Wheelwright, Rich Dad Advisor on taxes, as well as Ed McCaffery. He's an internationally recognized expert in law, went to Harvard and Yale, and an instructor at USC. He's the author of Tax Planning 101, Buy, Borrow, Die, is how you do that and not pay taxes. And Tom is the author of Tax-Free Wealth. Again, we don't endorse or recommend. We basically say this is what we do. And I suggest you, if you want to find out more about what Tom has to say, go to provisionwealth.com and definitely get his book, Tax-Free Wealth, and give it to your tax advisor. Because Kim and I have met many, many CPAs, and they have no guts. You know, they're more afraid of the IRS than we are, and that's the problem.
Well, we had one tax planning strategist, and he was so afraid. I still remember he said, "Oh, you guys are way too heavy in real estate. You should be in mutual funds." And we're like, do you know what we do? It was crazy. But here's the one big takeaway, and if nothing else, Ed McCaffery is the author also of the book Tax Planning 101, Buy, Borrow, Die, and he writes for CNN.com. And one thing he says, and he's very aligned to Rich Dad, is the truly rich don't live off salaries. They live off their capital, being investments, cash flow. So when the politicians say we're going to tax the rich, they're not taxing the rich. They're taxing the high wage earners. They're not taxing the truly rich who understand the system.
And it's like I said, this doctor friend of mine in California, he says, I finally made $1 million, but he's only going to keep $300,000. You know, I'm going, well, it doesn't make any sense to me. But to him, he's happy, he's making more money. And when I say, why don't you get Tom's book, then, you know, his fear goes up. He says, I don't want to get an audit. So he'll just keep working harder and harder and harder, pay more and more in taxes. And that's where I would say 95% of the people are. Tom, how much is the fear of the IRS to raising people don't make any changes, would you say?
Oh, it's huge. And it's like you say, it's not just the fear of the taxpayer, it's the fear of their advisor. I mean, I can't tell you how many times I talk to a CPA, and they're scared to death of the IRS. I'm going, why are you afraid of the IRS? I mean, you should know 10 times more than the IRS. Why would you ever be afraid of them? That would be like LeBron James being afraid of playing basketball against a high school senior.
Yeah. Well, and why are you not afraid of the IRS?
Because I have way more, I mean, put it in your terms, I have way more education than an IRS auditor. So it doesn't bother me. I understand the tax law. I understand how it works. And why would I be afraid of something I understand?
Well, so that'd be like me taking advice from a financial planner who just graduated with their Series 7. You know, I mean, going, give me a break here.
I mean, you actually end up educating the tax auditor, don't you?
Every time.
I love it.
I had one that actually asked me to write the report for her because she just did not understand the law. I mean, I spent time with her. She was very appreciative. I mean, I think, you know, IRS auditors, that's a tough job too. I mean, you know, so I don't hate IRS auditors. I respect them because they're doing a real tough job. but they're typically you don't go to a great school and get out with straight A's with the goal of being, working for the IRS. So.
Right. So, Melissa, go to Ask Robert right now. Once again, you can submit your questions to AskRobert@richdadradio.com. So, Melissa, what's the first question?
Our first question today comes from Sheila in New Orleans. Favorite book, Rich Dad, Poor Dad. She says, as an employee, what kind of tax planning can I do to keep more of my money?
Well, that's the purpose of this program. And once again, towards the end of the last part, you don't have to be rich to pay less taxes.
Correct.
You have to be better educated, which takes financial education.
You've got to be proactive.
And have a little courage, because you're going to find out most of your friends are absolutely terrified. Yet a lot of their friends are probably scamming a few bucks, tax-free, working for cash,
right,
which is tax evasion. Right, Tom?
Yep. That's exactly right. I think the average person probably does evade taxes in one way or another. Yeah,
and you go to jail for that stuff. I met this one guy who works as a porter at the airport. He says, I make about $150,000 in tips, but I only report 75 of it. I said,
right.
That's good advice.
So Tom, what can Sheila do as an employee?
She has to become an investor. She has to get the education, because an employee, the best thing she can hope for is to defer her taxes or postpone them. So, 401k, et cetera. That's really all there is for the employee. But if she takes her money and takes her knowledge and what she's learned over the years, and she applies it either into a small business or investing in some sort, that's where she will start to get the tax benefit. She has to be either an investor or an entrepreneur in order to get the tax benefit.
Proactive. What are some of the stocks they can buy to pay less tax?
Here's the thing. Buying stocks won't ever help you pay fewer taxes on your wages.
Right.
That's the thing about investing and being in business, is they'll actually help you pay less taxes on your wages, whereas buying stock just helps you pay less tax on your investments. And so if you want to pay less tax on your investments, buying stock, borrowing out, just like Ed says, is fine, but it really, there's nothing there that will help you unless you're doing it in a 401k. There's nothing that will help you to offset your income from it.
That's good to know.
Yeah,
that's good to know.
So that's a very middle class strategy, and people say get out of debt. That doesn't fit with us. Now most people are terrified of debt, also, as they should be.
Most people only know there's bad debt. They don't know there's good debt.
And that's what most people do.
Yes.
And they take advice from CPAs and attorneys who also do the same thing. The reason we have the second book in Rich Dad, Poor Dad is the cash flow quadrant, E, S, B, and I. E stands for employee. S stands for self-employed or small business or specialist like a doctor or lawyer. They pay the highest taxes. E's and S's pay the highest taxes. The people that pay the least are B's and I's. And so it's a complete mind shift plus skill shifts. So when I got out of the Marine Corps in 1973, my rich dad said, my poor dad wanted me to get my MBA. And he thought that would, my poor dad thought that'd be great. So I climbed the corporate ladder, and my rich dad says, you're not going to make it that way. It's best you become an investor. So in 1973, I took a little real estate investment course, and then I understood tax. And then I started buying real estate. So today, the reason Kim and I don't need jobs, we don't pay tax, we make a lot of money, is we started off in the I quadrant, not the E and the S quadrant. So if you understand that, it's pretty much mindset, which is why we have the Rich Dad Radio Show, and we thank you for listening to it. Next question, Melissa.
Our next question comes from Mark in Boulder, Colorado. Favorite book, Rich Dad Guide to Investing. He says, do you foresee the rich being able to continue to take advantage of the tax laws forever? Or put another way, will the tax laws change in the future, or could it be something more drastic, such as a revolution?
Well, in today's economy, anything is possible, and I think a revolution is not possible. It is possible, but not highly likely right now. But that was the American Revolution, 1773. It was a tax revolt. And the way Bernie Sanders is going in the American election and all that, and Hillary talking about taxing the rich, that fervor that we want to tax the rich is going to increase, and that's the concern. But I think a bigger question, I asked Tom this, aren't the tax laws basically the same all over the world, not just in the United States?
All over the world, they're the same. When we've been in China, we've been in Australia, we've been in
Germany,
Europe, we've been in Russia, and every time, it doesn't matter where we go. I always look at the tax law before we go in that country, and it's always the same. It's the wage earner who gets hammered, and it's the investor and the entrepreneur who get the tax benefits. And that will, to answer the question that was posed, that will I think, always be the case unless some politician or the public finally decides, you know what, we're not going to use taxes to for a policy as a policy vehicle. We're going to use taxes just to raise money. If that were the case, then we might see that revolution. But until that happens, until people are willing to give up their home mortgage interest deduction or their charitable contribution deduction or their 401k deduction, and as long as it's somebody else's tax benefit that gets wiped out and not mine, it's never going to happen.
So is revolution possible? Yes, but will people change? Probably not.
And also one of the things today, I mean, isn't it true, Tom, that about 50% of Americans don't pay any taxes?
There's a huge percentage that don't pay taxes. Their income is not high enough to pay taxes. So there is a huge disparity between the rich and the poor. I think, though, that, Robert, your designation of it is the high income earner, not the wealthy individual that's paying the high taxes, and the individual who is a lower wage earner, $100,000, $200,000, they're going to pay high taxes, whereas the individual who's the entrepreneur investor that's making $100,000, $200,000 will pay less taxes.
That's really the game, and so that's why we have Rich Dad Radio. That's why we have the Cash Flow Quadrant, Rich Dad, Poor Dad, Rich Dad's Guide to Investing, and all of those things. So you can submit your questions once again to AskRobert@richdadradio.com. We thank you for your questions, but just want you to leave you with this thought. The reason most people pay taxes has nothing to do with the rich. It has to do with most people are chicken. They're so afraid. And if you're not gonna make some changes, and you're gonna be more afraid of being taxed and what the government's gonna say, and what your tax advisor's gonna say, you'll probably just keep paying taxes. There is a kind of a little guideline that Kim and I have, and it's a saying that goes, for things to change, first I must change. You want to change the tax law, change yourself. And that's what the Rich Dad program is about. So I want to thank our guests, Tom Wheelwright, Ed McCaffery. Final words, Kim?
Yes, well, the bottom line for me is this program is about, if you're an employee, if you're working for a wage, the only way you're going to make a change in your taxes is to become a part-time or full-time entrepreneur and an investor.